The dollar index is back at a level that has triggered major silver moves in the past. Right now, the US dollar index, commonly referred to as DXY, is hovering near 102. And historically, when this level breaks with momentum, silver does not stay quiet. Most investors are watching silver's daily price fluctuations, but serious macro traders are watching the currency market. Because silver doesn't move in isolation. It reacts to liquidity shifts, bond yields, and most importantly, the direction of the dollar. Here's what makes 102 so important. Over the past several years, when the dollar index approached, and then decisively broke below the 102 zone, silver tended to experience sharp upside volatility within weeks. Not because of hype, not because of retail buying, but because a weakening dollar changes global liquidity conditions. When the dollar weakens, commodities priced in dollars become relatively cheaper internationally. That increases demand pressure. And leverage traders begin positioning for momentum. Now let's connect this to institutional structure. The dollar index reflects strength in the US currency relative to major global currencies, and its movement is closely tied to expectations around the Federal Reserve's rate path. If the market begins pricing in rate cuts or slowing economic growth, the dollar often softens. The Federal Reserve does not directly manage silver prices, but its interest rate policy affects bond yields, capital flows, and currency strength. When traders believe the Fed is approaching the end of a tightening cycle, the dollar often struggles to hold resistance levels. Right now, markets are debating whether the Fed is truly done tightening or if higher for longer policy will remain. That uncertainty keeps the dollar balanced at critical levels like 102. But here's the key. Silver volatility increases when macro uncertainty resolves. If DXY breaks and closes below 102 with conviction, it signals a shift in capital positioning. Hedge funds and commodity desks begin rotating into metals. And historically, silver tends to outperform gold during early dollar weakness phases because of its higher volatility profile. Silver is not just a monetary metal, it also has industrial demand exposure. That makes it sensitive to both currency shifts and economic expectations. Now let's talk about positioning. When the dollar weakens, traders using futures contracts through exchanges like the CME group often adjust exposure rapidly. Open interest shifts can accelerate price movement. And when currency-driven momentum aligns with positioning imbalances, silver can move quickly. The key is not predicting the exact day of the breakout. The key is recognizing the structural setup. Right now, silver is consolidating, while the dollar tests a major technical level. That compression phase is often followed by expansion. In past cycles, when DXY rejected from 102 and continued downward, silver experienced double-digit percentage moves within 30 to 60 days. Not every time, but often enough that macro traders watch this relationship closely. And this is where patience matters. Most retail investors react after the move begins. Institutions position before confirmation. The goal is not emotional reaction, it is structural awareness. If the dollar index holds above 102 and strengthens, silver could remain pressured in the short term. A stronger dollar tightens financial conditions and suppresses commodity momentum. But if 102 fails decisively, silver's volatility profile changes. That's why this level matters. This is not about hype. It is about intermarket relationships. Currency strength influences commodities. Bond yields influence currency. And Federal Reserve expectations influence bond yields. Everything connects. Silver does not move randomly. It moves when liquidity shifts. And right now, liquidity is balanced on a technical edge. So instead of focusing only on daily candles, watch the dollar index, watch 102. Because if it breaks with volume and macro confirmation, silver historically does not stay still. And if it holds, patience may still be required. This is the structural framework serious traders use. Not prediction, preparation.